Right. My fellow investors, welcome to the channel. Welcome to First Light. Okay, we need to have a really serious discussion about the trade deficit situation. Not just because it's, I think, the biggest policy change that this country has seen in decades, but also because the coverage in the mainstream media, I think, has been very, very poor. And unfortunately, like most things these days, the issue has become politicized, and therefore the discussion kind of ends up becoming a referendum on Trump, pro or anti-Trump. And depending on what channel you're watching, you'll see the discussion kind of skewed in one direction or another. And we need to move away from that. Financial markets are ideologically agnostic. At First Light, we are ideologically agnostic. We like to analyze policies individually and understand what the ramifications of those policies are in terms of the economy, financial markets, and ultimately shareholder value. But it's very important to not have an ideological spin and to look at things academically and objectively. And that's one of the reasons that we wanted to make this video. Now, before we get into the discussion, just the legal disclaimers that you typically hear apply here. This is not investment advice. We're not recommending anything specific. So all of those kind of disclaimers you're used to apply in this video as well. Now, before I give you the 10 things that I want you all to understand about the trade deficit, just a very quick word on First Light and myself. Okay, First Light, we're a registered investment advisor based in Boston, Massachusetts. We have 3 founding partners. We manage customized individual equity portfolios for our investors who are individuals or institutions. And we construct and manage those according to a person's sort of return objectives and personal individual constraints. That is what we do. We're not a one-stop shop. We don't do legal services or estate planning, anything like that. We just focus on building and managing customized equity portfolios for our investors. Okay, in terms of myself, my background, to know who you're talking to here, my name is Miguel Barron. I spent more than 30 years in financial markets and Wall Street and elsewhere. I began my career at the Abu Dhabi Investment Authority in Abu Dhabi, working for one of the largest sovereign wealth funds in the world. I was an equity analyst there. I also spent a few years at Santander Private Bank as well in Miami, and I was the portfolio advisor to the ultra high net worth group, so 50 million and above. And I was managing the equity portfolios of some of Santander's largest, wealthiest clients in Latin America. And then I spent many, many years on Wall Street in New York, working for very prominent investment banks, the last of which was UBS. Now, in terms of academics, I have a master's degree in international economics from the Johns Hopkins School of Advanced International Studies. This was just kind of 2 years, very, very focused on international economics, and international trade was a very, very big part of that. I have a bachelor's degree in international relations from UCSB, the University of California at Santa Barbara, and I'm a CFA charter holder. Now, for those of you that don't know what the CFA is probably the most recognized and respected accreditation you can get in the world of investment management. It's absolutely grueling. I think we're like the Navy SEALs of investment management. It's an absolutely grueling program, but absolutely excellent. So any of you out there that are considering a career in investment management, I strongly advise that you take a look at the CFA. Anyway, so that's a bit of background on First Light and myself. Now let's get to the matter at hand. Okay, the trade deficit and 10 things that I think you guys need to understand about the trade deficit, because like I say, most of the coverage just feels a little bit politicized to me, and we need to be very academic and understand how things work and why things are the way they are. So let's just start with what a trade deficit is. And it's kind of surprising to me because when I hear pundits, on TV, and even some people in the administration, when they talk about the trade deficit, you almost have the impression that they're talking about the budget deficit. I mean, they almost talk about it as if it were some sort of debt or some sort of hole that we have to get out of. And And that is simply not true. The trade deficit has nothing to do with the budget deficit and the national debt. And this sounds like a very obvious thing to say, but the way that people talk about it, I think we have to make the distinction. Now, the US has a massive debt problem. The budget deficit is running at historic highs for peacetime. We spend more money a year than we collect through tax revenue, so we keep issuing bonds, and we take that money and we use it to fund all the government programs that we fund. And of course, over the years, that builds a massive national debt. And that is a very serious issue, okay? The $37 trillion of national debt is a massive issue. The interest payments that the US makes now just to service the debt, we're spending more on just servicing the interest on the debt than we do on national defense. That's how bad the debt situation in this country has gotten. But that has nothing to do with the trade deficit. The trade deficit is just an accounting. It does not create, there's no value loss in it. There's no debt is created in it. It is simply an accounting measure. And it's very important that I'm going to give you guys examples so you understand what I mean. Now, if you go to a hairdresser or if you go to a car dealership and you perform a transaction, so theoretically you are creating a trade deficit with the hairdresser or a trade deficit with the car dealer. But in reality, no value has been lost and no debt has been created. It's not really a debt of any kind. All you have done is swap value from one form to another form. So if I have $100,000 and I buy a car that's worth $100,000, the moment after the transaction, my net worth hasn't changed. Before, the $100,000 was in liquid form. Now the asset is in the form of a product that has a market value of $100,000. But I have not become impoverished by it. My net worth hasn't declined because of it, and I have not incurred debt with anybody because of it. So there is no loss of economic value, and there's no debt that is generated. It is simply an accounting measure, because when you buy a foreign good, the dollars that we pay, those dollars eventually leave the country and come back through the capital account. But we record the dollars and goods that come and go from the country, and we calculate it. So that's called the trade deficit. But it's not debt per se, and it doesn't destroy value in any way. It's just an exchange of value from one form to the other. But like I say, and this leads us into point number 2, we do keep track of it because we keep track of the goods and dollars that come and go. Now, point number 2, and this is very, very important. The trade deficit, by definition, is balanced through what is called the capital account. So all those dollars that leave the US, because we keep importing, we're buying all these imported goods, the dollars leave the country, all those dollars eventually return to the US through what is called the capital account. The capital account is the flip side of the same coin. If you run a trade deficit, you're going to run a capital account surplus and vice versa. So all those dollars that leave eventually come back to the US in the form of asset purchases, okay? Those dollars are used by international parties, central banks, governments, etc., to purchase financial assets in the United States, and most of those are US treasuries. Now, this has the very, very positive effect of keeping interest rates in the United States low. Now, when you have a wall of money coming to the US to purchase US treasuries, you bid up the price of a bond and you lower the interest rate. There's an inverse relationship. We all know this, fixed income 101. But the trade deficit those dollars come back to the US through the capital account, and that has the effect of pushing down interest rates in the United States. Now, that is obviously very favorable for companies because they can borrow at cheaper rates. It means that they're more inclined to invest. It's very good for the consumer. It means that your mortgage rate is lower. It's good for the entire economy. So it's very important to remember that, yes, those dollars leave the US, but they come back to the US through the capital account and have the very positive effect of pushing interest rates down. That's very, very favorable. Okay, number 3, and this is a very important thing to understand, and I don't think people in the mainstream media do a good job of discussing this. Number 3, the trade deficit keeps other countries in the dollar system. Now, it's very important to understand this, that after World War II, and you had 2 blocks, the Soviet bloc and the Western bloc, the trading system became a dollar-based trading system. So countries internationally that want to trade, say Brazil and India want to trade timber or copper or whatever it is, those transactions are performed in dollars. And whenever a country needs to borrow money, from the IMF or World Bank or whatever it is, those loans are denominated in dollars. So we currently live in a dollar-denominated trading system. Now, in order for other countries to participate in that system, they need dollars. Now, when we run a trade deficit, dollars flow out of the United States and then return through the capital account, as I just mentioned. But the countries in the trading system need dollars in order to trade among themselves, and they need dollars to service their foreign debt. So other countries, in order to be part of the dollar trading system, they need dollars, and they will only have enough dollars if the U.S. is running a trade deficit. These are things that happen naturally, and this is why they occur. So if you notice, for example, if the U.S. ever goes into recession and you have a decline in consumption in the U.S., the trade deficit narrows, but that has a terrible impact on the rest of the world. You've probably heard the expression that when the U.S. catches a cold, the rest of the world sneezes. And this is why. Because if the U.S. enters a recession, for example, consumer spending declines, we import less goods, the tariff deficit shrinks, but it means that the rest of the world doesn't have enough dollars to trade among themselves and to repay their foreign-denominated U.S. dollar debt. So when the trade deficit shrinks, we are starving the rest of the world of the dollars that they need to be participants in the international dollar system. Now, it's very important to understand that, and it's not something that I hear too much about in the mainstream media. The rest of the world needs those dollars in order to operate in the system. Now, when I hear people in the administration say that on the one hand they want to reverse the trade deficit, but on the other hand they also say that they want to keep countries in the dollar system, well, these are two mutually exclusive objectives. If you want to reverse the trade deficit, the effect that you will have is that you will deprive the rest of the world of the dollars that they need to participate in the global system. Without dollars, other countries can't trade and they can't service their debt. So these are very, very much intertwined, and those two objectives are simply mutually exclusive. So the way to think of the dollar system is that the U.S. economy is like the heart, and it pumps blood, it pumps dollars out into the system, and those dollars circulate all the way around and come back to the U.S. once again, and that process just takes place over and over. But that's a way to think of the dollar system, and our trade deficit is absolutely imperative in order for the dollar system to survive and thrive. Okay, number 4. This is a bit more instinctive and just common sense. The trade deficit is absolutely natural and inevitable. Okay, now we are 5% of the world's population, but we consume 29% of all the goods and services in the world. Now, how the hell do you do that if you don't run a trade deficit? Now, the 5% of the world's population in the US, those consumers are disproportionately richer than consumers in other countries. So when you have 5% of the world's population consuming 29% of all the stuff, you're going to run a trade deficit. It's mathematically impossible not to, because that 5% can obviously not produce 29% of everything. So because of the relative purchasing power and the wealth of the US consumer, it is absolutely natural for there to be a trade deficit. But again, this trade deficit doesn't really have any significance because it's compensated through the capital account as dollars flow back into the economy. It is simply the way the machinery works. There's nothing necessarily dangerous or bad about it. So anyway, that's another thing. It's obviously we're going to run a trade deficit because there's too few of us with too much money. Now, one thing that, okay, let's move on to the next issue. And this is very important to the U.S. economy. Now, if you think about U.S. growth, now the formula for GDP growth is this, okay? C plus I plus G plus X minus M. Now, some countries are very dependent on the G for economic growth, government spending. You tend to see this a lot in developing economies where the government is a very, very big part of the economy and their spending kind of dictates the growth of the economy. Other economies are very much trade-based. So, historically, Germany, Japan have been countries that have always run surpluses, and exports have always been kind of the fuel of economic growth in those countries. Now, the U.S. is very particular in the sense that 70% of U.S. GDP is consumer spending. 70%. Now that's a very, very high number compared to other countries. But what is the last thing that you want to do when your entire GDP growth depends on the consumer? The last thing you want to do is stifle the consumer with unnecessarily high prices. What you don't want to do is freeze the consumer out. And if tariffs raise the prices of goods, which inevitably they will, this is what's going to happen. So when 70% of your GDP is consumer spending, tariffs are just not a good idea, and that's just simple math. Okay, number 6, and this kind of puts things into a historical context. Number 6, we wanted things this way. Okay, now that's something you definitely don't hear in the news. The existing world order is the way it is because we wanted it to be this way. So the U.S. has spent 80 years telling all the other countries in the world to join the international community, to join, that free trade is good, it's mutually beneficial, it creates wealth. We spent 80 years telling the world to get involved in international trade and to open their economies. So what we're doing now is really just diametrically opposed to what the U.S. has always advocated. So we have always pushed other countries to trade, and we didn't care too much about whether the tariff was, reciprocal or not, because what we wanted more than anything else was to give the U.S. consumer access to cheap goods. This was the goal of the entire trading system, and it's the reason that it looks the way it does, because in the post-war era, the U.S. was the hegemon. You had the Soviet bloc on the one hand and the Western bloc on the other, but everything that you see in terms of the West is designed the way it is because the U.S. wanted it to be this way, because it was beneficial to the U.S. economy. So you need to keep that in mind. Another reason that the U.S. Pushed so hard to have an integrated global trading system is to keep the peace. And it's also one of the reasons that the European Union was forged. Countries that are interdependent and economically intertwined are a lot less likely to go to war. If you need each other, you're unlikely to kill each other. And that was also one of the underpinnings of the post-war model that the U.S. Wanted to implement in the world, is a world where countries are interdependent economically, and by virtue of that interdependence, less likely to go to war. But make no mistake about it, things look the way they look because the U.S. wanted them to look this way for decades and decades. Now, during the course of this process, as the world became more integrated and manufacturing jobs left the U.S. to go to other countries, the labor that was displaced during that process simply found another home and moved up the value ladder. So those manufacturing jobs that you might think of in the 50s or 60s, as those factories moved away, and it accelerated in the 90s, when all of this happened, labor simply was displaced and moved into other parts of the economy, but labor in the United States moved up the value ladder. We are now a service economy predominantly. We run a massive surplus in terms of services, financial services, legal services, entertainment. We are a value-added economy, and labor in this country is more value-added. We're not a sweatshop economy. We're not a manufacturing economy. That is something that we shed in order for our labor market to move up the value ladder. So it's very important to understand that displacement is very normal in economics. It's called creative destruction, that sometimes to create greater wealth on the whole, you need to destroy something specific. So the reallocation of labor is normal and healthy, and it's a part of a growing and developing economy. So while all this happened, don't forget that the U.S. worker, he was laid off, but he found a home in other industries moving up the value ladder. Okay, now, number 7, let's think about this. Who is going to work in these factories? Let's say we magically, all these factories appear all over the U.S. Who's going to work in them? The United States is at full employment. So who's going to work in these factories? I mean, if you look at the unemployment rate in the U.S. now, basically, we are almost at something called frictional unemployment. Okay, frictional unemployment means that at any point in time in an economy, you're going to have a certain percentage of the population that is between jobs. I just quit this job, I'm going to start a new one in 3 months. That is absolutely natural. So at any given point in time, you're going to have a little bit of unemployment because workers are moving from one place to another. But we're practically there. I mean, we are practically at, frictional unemployment. So if we are at full employment, how are you going to populate these factories? because you're asking people to give up what is probably a higher value added job to go into a factory to do a very low value job. Now, why would anybody do that? Unless you pay them more money, which means that these factories have to bid up the price of labor, and that's counter to everything that we want, because that creates wage inflation, et cetera. So you have to ask yourself, who's going to work in these factories if we're already at full employment and we're a service sector economy? Are you going to quit your job as a consultant to move to another state to work in a big factory, putting bottle caps on bottles? It's just very, very counterintuitive. And why would you want the labor force to move down the value ladder instead of up? So it's very, very counterintuitive. Okay, number 8, who's going to invest in these factories? I mean, do you really think that international companies are going to now make massive investments in the U.S.? First of all, the rhetoric and the language that is being used by the administration is quite abrasive and a bit confrontational. I don't think it gives people a lot of security. This back and forth between tariffs and pauses and changing the rates, all of this uncertainty, I think, makes it impossible for companies to want to invest in the U.S. It's simply, it's just not a good bet. Some of these factories take years to develop, and are you going to invest billions of dollars and take years to develop a factory, and then in 4 years you have a new administration that removes the tariffs? It's very difficult to imagine that major corporations are going to be investing heavily in the U.S. Not just because of the risk and the uncertainty, but also some of the negative talk and some of the rhetoric that's being used that I think is quite confrontational and I think doesn't exactly lure money into the country. So that's another factor. Okay, number 9, and this is obvious, the economies we're too intertwined to dismantle the system. So even if you want to make a product in the US, a Boeing, for example. Okay, I understand that it's our strategic national, it's in our interest to build our own planes, but how many of those components come from abroad? It's actually really, really difficult to disaggregate yourself now because so many components in the car industry, in the aviation industry, in every industry, so many of the input products come from abroad and they will be subject to taxation. So to create what is genuinely an American product is a very difficult thing to do. I mean, for all of the components to be American and the end product to be American, it's an incredibly ambitious thing to do and very, very costly. So it's just very hard to imagine that you can disentangle a system that is so entrenched, so complex, and so interdependent. So it's just, we are too integrated globally in terms of supply chains to think realistically that we can dismantle it without creating massive disruption. Okay, number 10, and this is just blatantly obvious, the robots are coming anyway. I mean, if you go to a Tesla factory, you don't see a lot of people. You see a lot of robots, but you don't see a lot of people. And the natural trend in the world is for automation, is for robotics, for AI. All of these things are taking over production processes. And it's very difficult to think that now we're just going to, are we going to get rid of robots? Or are we going to have incredible technology in front of us but not use it because we want people screwing bolts in cars? The future of the world is in robotics, it's in automation, in software engineering, in artificial intelligence. That's where the world is going. The world is not going back to sort of 1950 where we're doing everything by hand. So it's very, if you kind of, we follow obviously the tech sector very closely. And if you see all of the innovations taking place in the world of tech, it's very, very difficult to imagine that somehow we're going to go back to manual manufacturing. It's just very, very counterintuitive. So look, those are 10 reasons that I think are just 10 factors that are very, very important to keep in mind when you think about this tariff issue. We want this to be resolved as quickly as possible. Whatever those final tariffs are, we need them in place and we need to stop moving the goalposts because it's rattling markets and it's very, very difficult to invest when you're one tweet away from an 11% intraday drawdown or rally. It's just extremely difficult to manage money under these circumstances. So those are our thoughts on the trade issue. This is, to blame America's economic problems on the trade deficit is like blaming the morning on the rooster. The trade deficit is a symptom of how the world works. It is not the cause of anything. It is not the root reason behind any of our problems. The trade deficit is an accounting issue. and it is the symptom, it is the natural result of the way global trade is structured. But it has been very advantageous to the U.S. In every respect for decades, and dismantling it, we think, would be very, very negative. I think it's very, very difficult to go back to any sort of version of America that you think of in sort of 1950 or 1960 or something like that. But anyway, those are our thoughts on the trade issue. Thank you for joining me. Look forward to covering other issues going forward. Thanks for joining me. We'll see you all in the next video. Thank you.